Investors are understandably anxious these days about the level of volatility in the market and the impact it may have on their retirement savings. Unfortunately, their nervousness is keeping many from doing the kind of planning that could help them ride out future storms, and many are not properly diversified. Uncertainty has them paralyzed. But proceeding without a plan may be the biggest mistake an investor can make in challenging times like this. My guest is financial advisor and radio host in Chicago, Dariusz Godlewski. And Dariusz, what is the biggest mistake you see with investors right now?
Well, common mistakes are usually not enough diversification, and they think they are diversified, but they're not, because it's usually a combination of bonds and equities. That's not a good diversification for this time. That's a terrible diversification at this time. And bonds, the bond side of their portfolio has a lot of risk at this point, but very little return. 2-3% for the risk they're taking. It's not enough. So bonds are not a good option right now. Equities, like you said, they think they're diversified in equities, but they have different funds, and stocks in those funds are usually, the top 10 are usually the same. So they usually have pretty high fees in those funds and things like that. So cost of those funds, that's a mistake. The people don't know how much they're paying, the internal costs. So they're just taking too much risk for not enough returns.
So someone's not well diversified. How do you fix that?
Well, first of all, they should be properly diversified, which most of them are not, just what you said. Into different asset classes. That's why I do index annuities, structured notes, and equities. These are three completely different asset classes.
So structured notes and fixed indexed annuities are asset classes that offer market performance and downside protection. The FIA has become a common bond alternative. Why does that make sense?
Okay, why? Because let's say 10, 20, 25 years ago, bonds were always that safe or safer part of their portfolio, and the potential of gains were, about 4 to 6% a year. Well, that's not true anymore, because bonds have much more risk at this point, because the interest rates are very low. So the cost of those bond funds or bonds are very high, and not enough gains. Most of those are doing 2 to 3% a year. But that's not enough gains for the risk they're taking. So index annuities are completely safe from the market risk, but we can expect a little bit higher, let's say 4 to 6% a year, like bonds used to have, that kind of growth potential, 4 to 6%, with a lot less risk than bonds have right now. So less risk, more upside as a bond replacement.
Now, for those watching who have planning paralysis, what's your advice?
So proper diversification over different asset classes, that's the key for less risk, more potential of growth than those traditional bonds and stocks, allocations. And if you want to be in the better strategy, do you want to be in that strategy sooner or later? Do you want to wait to be in the better strategy, or you want to be in the better, more diversified strategies as soon as possible? If you wait too long, you're just gonna be in the strategy that is less optimal for the longer period of time. So you're taking more risk with the less possibility of returns if you just sit on your hands and you don't do anything.
That's Dariusz Godlewski in Chicago, and this is Retirement News Online.